Hey, this is Keith Weinhold from the Get Rich Education Podcast. You are listening to my friend John Larson in the Real Estate Cowboys. Don't quit your daydream.
Hey everybody, it's Robert Helms, host of the Real Estate Guys radio show, and you are listening to the Real Estate Cowboys.
Have you thought about becoming financially free through real estate investing, but don't have the time or knowledge to get started? Welcome to the Real Estate Cowboys podcast. Each week, we discuss passive income investment opportunities in the red-hot Texas market. John Larson and the Real Estate Cowboys will show you how to leverage their team to build wealth in real estate through passive investment opportunities. And now, here's John.
Hello, my Real Estate Cowboys. This is your host, John Larson. Welcome to another episode of the Real Estate Cowboys podcast. This week, we are going to be discussing a report that just came out from PricewaterhouseCoopers, which is the second largest professional services company in the entire world. And each year, they put out reports on emerging real estate markets, trends, so on and so forth. So their 2019 report just came out. And their number one market to look out for in 2019 was Dallas-Fort Worth. Dallas-Fort Worth has returned to the number one spot after taking a year off. Last year was Seattle was number one. So DFW is back on the list. And it was not very surprising to me to see that because of the fact of many of the things that we talk about on the show all the time. It seems like every week, the growing population here, the very diverse economy, the job growth, the affordable real estate market here, affordable cost of living, room to grow, lots of land, all those things played a role in Dallas returning to that number one spot. And a chief economist for an institutional investor remarked that Dallas-Fort Worth, he said it's an interesting market, and it's one with the potential for strong future growth, but also with the liquidity of a gateway market like LA, Seattle, Boston, DC, so on and so forth. So they rank Dallas-Fort Worth as a market that's up there with these gateway markets in terms of liquidity. Second in that list was Brooklyn, which was kind of interesting. And Florida also had a lot of cities there in that top 20 as well. Orlando was in the top 5, Tampa Bay is in the top 10, and Miami and Fort Lauderdale rounded out, ranked in the top 20. So Florida is also a market that I really like. There's a lot of good, fast-growing cities in the Florida market. And basically, they are the ones that I just named. But DFW returning to number one was definitely not a surprise for me. And it makes me feel really good about the investment opportunities that we have going into 2019, which are mainly commercial developments, office buildings, maybe dipping into some retail space here in 2019. A lot of big things that we have coming up here in DFW in 2019 and seeing Dallas-Fort Worth return to the number one list from PricewaterhouseCoopers. It made me feel good, right? It made me feel confident that what I'm doing is right and I'm on the right path. They also had some statistics on employment growth going into 2019 and stability. So they have the 2019's top markets that are expecting high growth and low volatility. And the number one city that hit that list was Austin. So we all know Austin's been booming for years. It's continuing to boom. A lot of tech jobs moving into the Austin area. A lot of people migrating from California into Texas and primarily Austin, but also DFW. And so it was no surprise really to me to see that Austin was number one on that list. Orlando was second in terms of the actual potential growth, but it didn't have as good of a stability ratio as Austin and Dallas-Fort Worth. So behind Austin, DFW actually had the highest amount of growth with the greatest amount of stability, lowest volatility rating. So that makes sense to me, these Texas markets, because of the no state tax, because of the business-friendly climate. I totally can understand why these two cities in Texas ranked very high on that graph. Another thing, a couple other cities that made it into the top 5 were Raleigh, North Carolina, and Nashville, Tennessee. That rounded out the top 5. Boston remains in the top 10 as the highest ranked gateway market for 2019. Los Angeles slipped slightly from last year, but remains in the top 20. And the biggest movement of the gateway markets was the return of Washington, D.C. to the top 20 list. And I'm sure that is kind of attributed to the fact that Amazon has decided to move their HQ2 to the DC area. And then Seattle, that was ranked number 1 last year, has slipped to number 16 this year. But DFW back number 1. Very excited to see that. So there were a couple other things in the report that really stood out to me. One of the things was they were talking about debt funds and the popularity of debt funds in the market today. If you've been listening to the Real Estate Cowboys podcast on a weekly basis, you know that we're very much involved in debt syndications now and going to our lenders for private lending or investors for private lending to go take down these commercial buildings here in the DFW market or build new commercial buildings here in DFW, because there is a very big demand for those spaces here. And I expect that demand to continue into 2019. But there's been a rapid growth of private debt funds over the past 10 years, basically since, the last recession of 2018. And they filled an important gap in the liquidity crunch that started in the last recession. And the benefit of the debt funds is they were able to offer higher yield loan products in a returns-hungry real estate capital market. So a lot of our investors are looking for these higher returns on their money and higher cash flow, and debt is a good way to get that. Debt funding is a great way to make that happen. These debt syndications that we offer, most of them pay 10.5%, and some of the opportunities can pay as much as 12%. So great way to earn truly passive income on your investment dollars. The benefits of a debt fund for us is they provide higher leverage, in some cases 100% loan to value. It's a greater speed, easier to deal with than going to the banks. And I really expect banks to get real tight with their funds moving into 2019. They're already talking about raising the interest rates again, and the interest rates are supposed to get up to 5% for a retail home buyer here in 2019, which means that the rate's going to go up even more for investors. Right now it's sitting at about 6% or greater. So I expect that to continue here in 2019 and beyond. Obviously, it's attractive to us as borrowers because we can get deals funded faster and a lot easier by syndicating debt from our investors as opposed to dealing with the banks. And that price premium that I talked about is passed on to you as the investors. So it's a win-win. We're willing to pay our investors a higher interest payment than we may with a bank, but these banks are going to require more money down moving forward, I believe, and they're just going to be a little bit more difficult to work with. I don't think that banks will be as lending money as easily as they have been in the recent years. So we're just trying to get ahead of that problem, which is why we've opened up our private money lending program. And we have over 100 investors who have invested in our private money lending opportunities since we started in 2018 and now moving into 2019. And we're about to finish up funding another deal that we have that I've talked about up in North Dallas. And we'll be looking, I actually have a couple opportunities I'm looking at in the DFW area that we will start raising for here soon. As you know, last week I was talking about the popularity of CBD. We're very much involved in that business as well. We may be looking at potentially starting a CBD facility in Denver. So maybe we'll also be looking in the Denver market for a possible private money lending debt syndication for our CBD business. And actually Denver ranked 8th on the U.S. markets to watch, just behind Austin. They're at 6, Austin at 6, and Boston at 7. Next was Denver. So Denver's there in that top 10 as well. So we believe that Denver is still a really solid market to invest in real estate also. So we'll see what our next syndication opportunity is, but it's going to be something here either in Dallas or maybe possibly Denver, like I said. And our investors, are seeing double-digit fixed returns on those opportunities. And perhaps if we move up to Denver, we might even be able to offer a higher rate of return on our debt syndications, which has been pretty much at 10.5% here on the past few deals that we've done. So, I found it interesting that the report from PricewaterhouseCoopers was also talking about the popularity of debt funds moving forward. They also touched on the fact that equity syndications, although they may provide higher yields, they're more vulnerable to losses in a downturn. And I am expecting to see a bit of a downturn. We're already kind of seeing it in many markets across America, a downturn in the real estate market, which could have a negative effect. It will have a negative effect on the returns that were promised to you on an equity syndication, because obviously in a downturn with the volatility in the market, these sponsors may not be able to sell the property at the price that they thought they would, right? When the market was more healthy 1, 2, 3 years ago. We're definitely coming into a correction. I've been talking about that a lot on the show. That obviously could have a big, big hit on any equity syndications that you have going on. It's not a guarantee with an equity syndication. You're not getting a guaranteed return. It's, hey, if everything goes according to plan, you're going to see a 30% return on your money. So a lot of my investors are moving towards the debt syndication opportunities because it's pretty much a guarantee in terms of what you're going to be collecting each month on your investment. Now, we still need to exit out of the properties as well, but in most cases, we're going to be performing a refinance and just holding the investment as a cash flowing vehicle, just like I would a single family home. But, I prefer working with business professional tenants that have long-term leases in there and only occupy the facility 40, 50 hours a week max, as opposed to living in the property 24/7 with their kids and everything else. So I just like commercial real estate more in that it's more passive, and it's a better experience for all of us involved. And it's really easy to refinance those type of opportunities. And there's still attractive loans out there for refinance on a commercial space, especially in the Dallas-Fort Worth market. Really, like I said, excited to see Dallas-Fort Worth back in the number one spot. And like I said, makes me feel really good about investing more dollars, more of my own dollars and more of my investors' dollars into this market moving forward. The 2019 population growth rate in Austin is projected to be over 3 times the national rate, while the rate is forecast to be over 2 times greater in Dallas-Fort Worth and San Antonio. So I think that's another reason why these 3 cities have made it back in the top 20 and DFW sitting at number 1. It's because of the population growth. These cities are growing exponentially. And we talk about this just about every week as well, that, about 1,200 people a day move to the state of Texas. About 400 of those people are moving to DFW, and a large portion are moving to Austin as well, right? So for Austin to be projected over 3 times the national rate, it's crazy. And, they just talk about Dallas-Fort Worth, Houston, Austin success is really based on the migration, the population growth. Austin, Dallas, Houston, Oklahoma City, San Antonio all have a significantly higher percentage of their population in the 0 to 24 age group and 25 to 44 age groups. So the younger population is supporting good labor force growth, right? We have a lot of younger people moving and migrating into these areas. So a very, very strong job force here, which is great. Business startup activity is high in Austin, DFW, and Houston. The affordability of single family homes is also a big reason why these cities are on the tops of this list. So it makes sense in my eyes. And this is all things that I discuss on the show a lot is, that affordability, the population growth, the job growth, the diverse economy is all playing a role in why these markets are so popular and are on investors' radars. And so if DFW is not on your radar, I definitely think that it should be coming into 2019, just with the volatility of the market that we're seeing in other areas around the country. So I think it's a good way. I definitely hedge your bet coming into 2019 and beyond with these fast growing markets, right? I think DFW kind of fell off people's radar for a little bit when the economy just all over the country was doing really well. And obviously there's more affordable areas in the country to maybe buy rental properties and things like that. And, we know that the property taxes in Texas are pretty high, which that has a negative effect on your cash flow. And the rising interest rates aren't helping with the cash flow now. But now that we're starting to see some volatility in the market, you're starting to see the cities with the very diverse economies and the high population growth starting to rise to the top again as areas to invest for institutional money, for private money, for just the regular everyday investor who wants to build a rental portfolio or lend some money on a commercial project. It's starting to take notice that, the cream is rising to the top again, and DFW is back number 1 because of that, I believe. Just very, very low risk because of the economy that we have and the population growth, right? There's going to be demand here because jobs are moving into the market, because people are moving into the market, because the workforce is young and strong. That is why I believe you're seeing 3 Texas cities hit the top 20 and, Dallas-Fort Worth at number 1. Now, some other cities that I know are popular and on people's radar in terms of building rental portfolios and investing dollars in have not registered as high as they have in recent years. Now, some of the other markets that we invest in, like Kansas City, That kind of still hit the middle of the road, came in at 35, which that's pretty much what Kansas City does. It's always kind of been in the middle of the road in the years that I've invested in that market, and even people who are older than myself that have invested in Kansas City have always kind of said, you're never going to see huge appreciation and huge demand, but you're never going to see, the property drop in value too much. And it just kind of stays in the middle, which is good for investing in single family homes, I believe, and building a rental portfolio. Just kind of stays consistent. Another area that we're in that you may or may not know is St. Louis. So St. Louis ranked 46, kind of still in that middle of the road area, but just below that fault line where they're saying, that's the median fault line. So 45 was the where the median fault line ended, and St. Louis was just below that. Some other areas where I know a lot of investors out there, they have these markets on their radar. Indianapolis was at a healthy 19, which is pretty good. 3 Florida cities made that list. So you had Orlando, you had Tampa Bay two of those were in the top 10, and then Miami was right there at 12. I think Florida still very, very strong opportunities there. I've always liked North Carolina, and Raleigh I think is a great area. It's still affordable real estate, diverse economy, and growing very quickly and still growing rapidly. Other areas like Detroit, that came in at 44, Jacksonville 48, Chicago 49, Birmingham, Alabama 50, Cleveland 60, and then you have Memphis down there at 71, which is very low. It's more than one standard deviation below the median. So that I know has been a popular area for a lot of investors to look at, but I just feel like it doesn't have the economy to support long-term growth and stability. And I just feel like more and more people are moving out of the Memphis area than moving in. I'm going to have a copy of this list on our Real Estate Cowboys website. So if you want to take a look at this list, you can go to realestatecowboysdfw.com, see where your cities rank, where you're investing. And if you want to get some ideas on where you should possibly invest coming into 2019 and beyond, and there's some cities that have been on your radar, definitely take a look at this list. And I think it's really, really accurate. We're going to take a quick commercial break. When we come back, I want to talk about a few more things about markets to watch and look out for and maybe avoid in 2019 and beyond with this potential volatility in the market. And I also want to check in with Taylor Glasgow again, who runs our private lending department, just get an update on where we're at with our current raise. I think from what I heard this morning, he said we're almost fully funded. So I just want to give our listeners an update on where we're at on our current private lending opportunity, see if there's still room to get in on this opportunity and start collecting double-digit returns here in 2019. Really, really solid opportunities, safe opportunities. So we'll be right back after this message.
Looking to complete a 1031 tax-deferred exchange and are needing financing for your replacement properties? Let Graham Parham at Highlands Residential Mortgage guide you through the process and make your 1031 exchange go smoothly and on time. As a seasoned investor, Graham owns several investment properties himself, and he can share with you the best way to plan your exchange. Graduate into a better property or properties and make use of leverage to obtain better cash flow and higher returns on investment. Highlands Residential Mortgage has one of the best in-house loan processes to deliver your loan on time and without any surprises. We are 1031 exchange friendly. Call Graham's toll-free direct number today at 855-326-6802 for your free mortgage consultation, or visit us online at texasinvestorloans.com. Highlands is an equal opportunity lender, NMLS 195724, located 1201 North Central Expressway, Dallas, Texas 75234. Highlands Residential Mortgage, NMLS 134871, is not a financial advisor.
And welcome back to the Real Estate Cowboys podcast. This is your host, John Larson. I'm bringing in fellow Cowboy Taylor Glasgow. If you have been listening to the Real Estate Cowboys, you would have heard around Christmas. Taylor was recently on the show. I wanted to bring him in just to kind of give us an update on our current private money lending raise that we have here in the number one market in America, Dallas-Fort Worth. So Taylor, you're the one that's on the phone with all the clients all the time. I just kind of wanted to give the audience an update since a lot of Real Estate Cowboys listeners are investing in our private lending opportunities right now here in Dallas. So can you just give us an update on our current lending opportunity in Dallas, up in Carrollton, our office building, And how much have we raised and how far are we away from funding? Is there still an opportunity for our listeners to get in on this deal?
Hey, John, thanks for having me on again. There is definitely still an opportunity to get in on this deal. We are at 2.575 in order to close on the asset. We only need about $225,000 more. The investors that come in this month and invest with us this month, they're actually going to start receiving interest payments in February. Next month, we're going to be raising the remaining amount, the $800,000, which is what we need for the renovations. So there's definitely still a chance to get in if you guys want to get in. If we spoke before, you have my direct line. You can call me at that number. You can text me at that number. Let's see if we can get something moving.
All right, sounds good. So what I'm hearing you saying is we have just over 2.5 million. We need 2.7 million to actually close on the building. And then the remaining 800,000 we can raise later and add the investors on the deed of trust later. And those investors that come in on the 800K remaining for construction and holding costs and other fees there, those investors would receive their interest payments later. But if you get in and can help us fund the remaining 2.7 million to close on the building, you can start seeing your returns in February. Is that what I'm hearing here?
Most definitely.
Okay, sounds good. My next question would be, it seems like we have a lot of investors who have invested on our South Lake projects in South Lake, Texas, also here in Dallas, who have already started to invest again on the Carrollton offering. Why do you think that is?
Well, private lending is getting a lot more popular. I mean, essentially, what you guys are doing is taking the position of a bank, right? So we have investors that have came in with us on the South Lake projects that just saw how smooth the program was, how passive it actually was. They get their interest payments on time every single month. So they just, they like this deal because the collateral is an asset that's already spinning off $49,000 a month in cash flow. It's already there. It already exists. And it's only a 12-month term. So a lot of people like that. So they're going to have, returns coming back to them whenever that note matures. One's going to be happening in 12 months. And then the following year, they're going to have one coming in after that. So if you set this up right, you can have return of your capital come in year after year.
Good point. So they're diversifying into other projects, right? And the benefit of this Carrollton deal is it is a shorter term, right? So we can recycle the money into another deal fairly quickly. And the fact that the building's already there and already cash flowing is very attractive. So I talked about this on the show today as well, about the gaining popularity of debt syndications, debt funds. What would you say our clients like best about our private lending opportunities? And, you told me that you drove by the South Lake opportunity just recently. Where are we at with that project?
That project is actually ahead of schedule. Our partner, David Keener, has been very diligent on getting things done. We actually thought that only the framing was going to be done whenever I drove by it the other day, but they already have walls up and they're rocking and rolling on it. So, this program is gaining a lot of popularity. For one, we're doing deals in the best market in 2019. Dallas was ranked number 1 again. So a lot of investors are looking to place funds into this market. But then again, we have a lot of people that don't necessarily want to take on the risk of owning a turnkey rental or buying an asset right now in this market. So, getting that steady stream of cash flow, that fixed rate of return is something that people are obviously looking to get right now in this market.
Right. And like I talk about, very, very passive. You're receiving checks from our accounting team each month, and that's pretty much all the communication that you have to have with us. And then obviously we're providing updates, photo updates, video updates of where we're at in the project, just to kind of keep you engaged, keep an eye on how your money's working for you. So great, Taylor. Thanks for coming on the show again. And for those of you who are interested in getting in on this current offering that we have, it sounds like we're coming up right on the tail end. Go to realestatecowboysdfw.com, put in your information, and Taylor and his team will reach out to you and discuss the next steps and let you know if there's still a position available. If we can't get you in on this deal, we'll have another deal ready to go probably here in February, late February, early March. So don't be alarmed. It'd be great to get you in on this opportunity and start collecting an interest payment as soon as February. If not, we can get you in on the next raise. And so realestatecowboysdfw.com or AREIUSA.com. That's American Real Estate Investments website. Great information on both sites. You could also go and download my book, The Passive Income Guide, What's Your Return on Life? There's great information on debt syndications, turnkey rentals, property management, lots of stuff that we talk about on the show. You can just read right in a quick, easy to read book. So thanks for tuning in. I hope everyone has a great week. And always remember, what's your return on life? This is John Larson signing off.
All opinions expressed by the hosts of the show are the opinions of American Real Estate Investments, LLC, and do not reflect the opinions of guests or sponsors. No personal or professional advice heard on this program should be considered an endorsement to follow a real estate financing or investment strategy. Before acting on any information, seek advice from your financial, tax, mortgage, or real estate advisor, as the information is not guaranteed and investment strategies have the potential for profit or loss.